On August 12, 2026, H&R Block shares rose 16.1% in a single day. The stock closed at $54.18, and the reason is about more than one good quarter. The company beat Wall Street's earnings expectations for its fiscal fourth quarter, raised its outlook for the next fiscal year, announced a 10% dividend increase, and, in doing so, finally pushed the stock back above the level it had traded at before a devastating crash earlier in the year. To understand why that mattered, you have to go back about 10 months. In mid-October 2025, H&R Block was trading at $52.59. Then the stock fell apart. A fiscal second quarter report missed on earnings. Investors were unimpressed with the company's new product launch, and by February of 2026, the stock had dropped about 46% from its peak, bottoming out at $28.43 a trough. The company started recovering after a much stronger fiscal third quarter in May. That report beat estimates, included raised guidance, and sparked a 23.8% rally in a day. But even after that bounce, the stock was still trading below the high it had set back in October. So as we approached the fiscal fourth quarter report in August, investors were looking for proof that the business was truly back on track, not just that a single tax season happened to be a strong one. The company delivered that proof. H&R Block reported quarterly revenue of $1.14 billion and adjusted earnings per share of $2.38, both above analyst estimates. It wasn't just a beat. Management also raised its forecast for fiscal 2027, announced a 10% increase in the quarterly dividend, and reiterated that it's still buying back shares. The response was immediate. The share price jumped 16.1% on the day, closing at $54.18, which was above $52.59. Psychologically, the entire drop from October was now formed. Now, why would a beat and raise cause a 16% move? It helps to break down what each part is saying. First, the earnings beat. When a company reports numbers above what analysts had been expecting, it's not just a number in a spreadsheet. It's evidence that the current business is performing better than what the markets guess. That changes the calculation investors make about what future earnings might be. Second, the guidance raise. Guidance is the company's own forecast of what it expects to earn in the year ahead. When a company raises that forecast, it isn't just flattering itself. It's telling investors that, in the view of the people who run the business, things will be stronger. Without any mention of guidance, investors are left guessing. And when they're left guessing, they tend to put in worst-case scenarios. A raised guidance closes the door on the bear case. Third, the dividend hike. Notice the company pays a shareholder distribution each quarter. A 10% increase means more cash in the pockets of anyone holding the stock, and it signals that management is confident enough that it can afford to give more money to shareholders. Those three things together aren't just a better set of numbers. They're a direct contradiction of the story that had been dragging H&R down for months, that the business had peaked, that its growth was fading, or that the company's recent struggles were a sign of something worse. One strong report after a big sell-off, and investors could step in and reprice the stock accordingly. So that explains the jump. It also partially explains why the gain wasn't permanent. By August 17th, the stock had faded to around $50.13, remaining below both the $54.18 spike and the $52.59 pre-crash recovery. Profit-taking after a built-in day is an ordinary instinct. A one-day jump like that sets you to buy some water for the next few sessions, and a stock that just gained 16% has people naturally taking some gains. More importantly, the fundamental state of the company, a strong quarterly result, a raised outlook, and a growing dividend hasn't changed. What's still open is whether H&R can build on the momentum and stabilize above the level reached in October, or whether investors will wait to see one more fiscal year that confirms that tax season strength isn't a one-off deal.